Okay, so now let's see an example, a long form example of deferred tax liability from a depreciation timing perspective. So there's a company whose name is FedEx Corporation, and they buys the delivery trucks and uses different depreciation timing for books and tax, because this is very common in practice. Income tax or the federal tax says there is a difference in different method for depreciation versus GAAP says different method of depreciation. Now the enacted tax rate is 21%. Now they say in year 1 tax depreciation exceeds book depreciation by 10,000. So you can say if I write here books, and if I write here as tax, so you can say tax depreciation exceeds books depreciation by 10,000. So in tax depreciation, let's suppose it is 20,000 as an expense shown, then the book depreciation will be how much? Negative 10,000. You will say, how did I got this number? Basically I know that the tax depreciation exceeds book depreciation by 10,000, so the depreciation expense here is higher than 10,000. I can take different numbers as well. If I, let's suppose if I take in books the depreciation is how much? Negative 120,000. Then in textbook how much depreciation will be there? It will be negative 130,000. In effect in textbook there will be higher depreciation of $10,000. So now what you need to write here so that both of these numbers matches? So you will see that this, if I write negative 10,000 here as well, so I will get 130,000 as per taxes. So this is negative 10,000 and I will call this as a deferred tax liability item, because I need to calculate tax on this. But so the reason is like I'm calling this as a deferred tax liability item, not the deferred tax liability today only, because on which I will be calculating some impact of taxation. Uh, Now what happens? They are saying that this creates a deferred tax liability. As we had seen, more taxes will be owned later, because if you logically want to also understand that, then you can simply say that right now in your tax books extra expenses is there. This extra expenses reduces your income more, and if the income is reduced more, your profits are reduced more, and if your profits are reduced more, your taxes are lower today, and if your taxes are lower today, you will have to pay those taxes at a future point of time, and this will create a deferred tax liability for you. Now in the year 2 they are saying books depreciation exceeds tax depreciation by 10,000, and this gets reversed. So in the year 2 this will get eliminated. So if I make the picture of year 2, you can simply say this is my books and this is my tax, and simply book depreciation exceeds tax depreciation, right? So here that book depreciation may be 130,000, I don't know what may be the number, but the tax depreciation may be 120,000, and you need to see what you need to write here so that both of these number matches. So you will say I need to write plus 10,000, so that this become negative 120,000 and both of them matches. Now this becomes your deferred tax asset item here, and this above was 10,000 as a negative item, and this below is 10,000 a positive item. So what will happen? These both of them will get set off with each other, to which we call as the elimination. Now based upon this question we need to see some accounting entries and how does this work. So you know that your gap book income right now is how much? So let me go ahead, and this is a scenario wherein you need to write your gap book income, which is $100,000. Okay, now you may say where is this written in the question? Basically this is not written here, this is just for your understanding, so it's a continuation. Okay, now what you will say, in the year 1 my deferred tax liability is created for 10,000. So this deferred tax liability extra depreciation you reduced from this year 1's income, so you get a taxable income of how much? 90,000, and this 10,000 which was here, this creates a temporary difference. Okay, and if you need to calculate the taxes today, you will say on this 90,000 I will be paying taxes, right? So this 90,000 you will be paying 21% tax, which comes at 18,900. And at this 10,000, you know, this is your what, this was negative number, so this was your deferred tax liability item. And on this deferred tax liability 10,000 you will be calculating 21%. So this 21%, this number is known as your deferred tax liability. This 10,000 was not your deferred tax liability, this was deferred tax liability item on which the tax rate is applied, and this deferred tax liability is 2100. Now your total income tax expenses will be 21,000 if you add both of them. But to income tax department, what you will be paying, you will say to income tax department, I will be paying only current tax, right? Because this is what income tax is asking from me, that on a 90,000 income pay 18,900. So what journal entries you will be passing, you will say that my income tax expense, because this is your expense is what, 18,900, this is your expense, and all expenses are debited, this is debited, and against this 18,900 there is an income tax payable, because you need to pay that amount to government. So you say I have credited that 18,900 here as well. Now what about this 2100? You will simply say these are also my income tax expense, but these are my deferred income tax expense of 2100, and this will go into your books of accounts entry. But at the same time you can say I need to write it in my liability as well, because I need to pay these amount in future, I will be paying these taxes in future. So somehow this became credited to deferred tax liability, and this became income tax expenses, which is deferred on a debit side. Okay, now let's come to year 2. Now in year 2 what will happen, you know that your book depreciation is greater than tax depreciation by 10,000. Effectively we had seen above that that 10,000 above, you know that you have that 10,000 which will be reversed in the year 2, so you will get the impact of that. So what will happen, let me tell you, in the year 2 you know that this deferred tax liability which was credited here, now this will get offset, this will get offset with what, you will need to reverse that deferred tax liability here. So you have reversed that entry by debiting that deferred tax liability, and what you credited, simply you have debited this income tax expenses here, so you need to credit that income tax benefit or expenses here. So this entry gets the nullified impact of deferred tax assets. Now you may think like, why we haven't created any deferred tax assets in the year 2, although it was a plus $2,100 above. Then I will respond that since it is getting nullified, so nothing new is getting created, and if nothing new is getting created, you don't need to pass the entry of that deferred tax assets. Okay, and I hope you understood this. In the next session we will see deferred tax assets example based upon the similar trajectory.